What's up, guys? I'm Mason Rad, real estate agent here in Los Angeles, and today we're going to discuss how the dollar and the euro are at parity. And you know what that means. Time for a European vacation. Let's get to it. For the first time in 20 years, 1 euro is worth just $1. That's also known as parity, which means the exchange rate is 1 to 1. But before I pack my bags and start posting FOMO-worthy picks from Europe, let's discuss the factors that are causing this parity. You might be surprised that one of the correlating factors is from the US real estate housing market. The Fed raising interest rates to combat inflation and reset the prices in real estate has given US travelers' budgets a boost. I was surprised to learn that these things were correlated. Today we're going to look into the factors weakening the euro, and considering the rising US and European inflation rates, are US travelers really seeing any savings? And of course, I'm not going to miss an opportunity to talk about real estate, so pack your bags because we're going international house hunting as I discuss what factors to consider if buying a European vacation home. And I list some of the top places to buy real estate as an investment property in the Eurozone for an American or a foreigner to Europe. First, let's discuss what many Americans believe is the best way to take advantage of this parity. And it isn't by booking a European shopping excursion. It's actually booking a one-way ticket to the content destination that is my channel. So please, tap that subscribe bell and please hit the like button before the YouTube algorithm if you haven't already done so. Now thanks. Let's get back to how Americans are actually looking to capitalize on the unusually weak euro, and that is by making risky bets on the currency market, otherwise known as Forex trading. Traditionally, currency trading has been reserved for Wall Street desks, but retail investors are flocking to make bullish bets on the dollar bills, y'all. This is similar to the frenzy that occurred with the meme stocks like GameStop and AMC last year. For me, FOMO trading hasn't given me the best results, and I would exercise extreme caution getting into the currency markets right now. As always, I'm not giving financial advice, so make sure you do your own due diligence before making any investment decisions. The euro has been under a lot of pressure since the beginning of the year. It has lost around 13 US cents in value. Factors such as the war in Ukraine and dependence on Russian gas are hitting the currency. The last time the dollar and the euro were at par was in December 2002. Since then, the euro has held its own quite well against the dollar. And in December 2007, 10 euros could buy you 14 US dollars. The two currencies reached their highest difference during the financial crunch of 2008. At one point, 10 euros could buy you almost 16 US dollars. And now they stand 1 to 1. 10 euros gets you just around $10. This euro and dollar parity is combined with the current level of food and industrial goods inflation that has not been seen in Europe since the mid-80s. And the relative increase in the price of energy in recent months is higher than it has been in over 40 years. In some ways, the story of the weak euro is more of an energy story than a currency story. Now currency traders expect the energy crisis and higher energy prices to really dent the economic growth. So we are looking into a recession in the European economy in the fall and the winter. Euro-dollar parity also means the Eurozone exports to the US are cheaper, a possible silver lining for export-oriented countries like Germany. But US goods are also now more expensive for Europeans to import as well. So for many Europeans, there is mounting concern about rising food prices and the looming energy crisis, coupled with the fact that all other commodities are invoiced in US dollars. The energy commodity bill for the Europeans will likely increase even further. For businesses, this means passing those costs on to customers, who are already struggling to keep up with higher consumer prices. Eurozone inflation is at a record high right now, and consumer prices for Europeans were up 8.6% in June 2022 compared to a year ago. With all the inflation going on in the world, are US dollar holders really getting such a good deal right now? The short answer is yes. The weaker euro is a headache for many Europeans, but for US dollar holders, their cash will go farther now in Europe than it has in a while. The euro is down around 17% versus the dollar since July 2021. Even considering the possible increase of European inflation of 8.6%, US travelers are essentially getting a 10 to 15% discount on much of their travel costs. And that's why US travelers are trading in their anniversary trip to the south of Florida to the south of France. Since they won't have to pay as much for flights to Barcelona or a hotel room in Mykonos, tickets to the Paris Opera, or a 5-course dinner in Rome. So all this has got me thinking, if it's cheaper to go to Europe, is it cheaper to buy real estate too? Well, inflation in Europe is still somewhat lower than in the US, so you could argue that with this weaker euro, the US dollar holders would get a better bargain. plus a little extra savings if you deduct the cost of travel. Europe is currently one of the weakest spots right now in the global economy, suffering from higher energy and commodity prices and uncertainty. Obviously, they can't control the war in Ukraine, which is disrupting energy markets, and these factors have made traders and investors actually withdraw their investments from Europe. This means it might be the right time for speculative deals in the European real estate market for buyers who can afford it. But whether it is or isn't cheaper right now or the right time, let's look at what you should know before investing as a foreigner in Europe, and let's get to my list of the best cities and countries to buy real estate as an investment in Europe. First of all, let's talk about the factors we should consider when choosing a place in a country or a city to buy property in Europe. Starting with one of the most important factors, and that's the cap rate, or the rental yield you'll receive for your property in the first year of ownership. This is how much your property will yield in 1 year considering its full price. So for example, if you buy a €100,000 or dollar property and it generates a net income after your costs of $10,000 or euros per year, you have a cap rate or rental yield of 10%, which would be extremely good, but typically also a cap rate of around 5% is desirable. Another factor you should consider is whether the city or the country has a net population growth. That is, if the population is growing steadily over the years. As you may have heard, there are actually cities who will give you free houses or pay you to move to their city in Europe because of the drastic decline of residents over the years. But typically, those come with some strict stipulations that don't make them necessarily the best investment opportunities. For instance, some places require you to make it your primary home for several years and spend the majority of each year living at the property, which doesn't work well as an investment property. So negative population growth may be an opportunity for an expat, but a huge risk factor as an investment. Another important factor to consider is the influx of tourists or short-term visitors. Those are potential short-term tenants or people coming for a short-term stay. If you want to invest in an apartment and rent it off on any other type of short-term rental platform, that's an important factor to consider, so don't overlook it. Another essential factor is the likelihood for appreciation in the property's price. So for example, if you are investing in a country with a developing currency such as Turkey, it is harder for the property price to appreciate over time as the currency is going down yearly. And then another important factor is the low taxes. In Europe, taxes are one of the most important considerations. Firstly, you should consider the tax on the rental income and then on the capital gains tax as well. Finally, you should also consider whether the country or the city has friendly laws for foreign investors. Some places have a great quality of life and a good property market, but it's very hard for foreign investors to buy a property or to move to that country. Now let's talk about my top European real estate investment destinations. Let's kick off the list with the first country and city, and it's Spain. It is also a pretty popular destination in Southern Europe, so you can capitalize on short-term rentals on platforms like Airbnb, Booking.com, and many others. On top of that, Spain has several residence permit categories for non-EU citizens, like the non-lucrative visa or the Spanish golden visa. The rental yield in touristic destinations in Spain, such as Valencia, is currently slightly above 5% per year, which is pretty good for Western Europe. The second place on the list today is Ireland, including Dublin and other cities. The last few years have been extremely positive for the economy of Ireland, and that includes the local property market. Ireland has benefited from its low taxes to attract some of the largest global internet conglomerates to establish their European headquarters in the country, including Apple and Google Alphabet. Ireland also benefited from attracting other companies that depend more on business with the European Union. This has also resulted in skyrocketing property markets in Dublin as well as in other cities, which have led to a heavy surge in rental prices. Ireland also offers residency by investment. And the next place is Portugal, and especially the city of Porto. It has great potential for real estate investments. Apart from that, the city also has a higher than average quality of life. For Western and European standards, Porto has everything one should expect from a great place to invest in a property. It is a large city with a significant transit of business people. Apart from that, it also has an important university in the European academic scene. Finally, Porto is also one of the most sought-after tourist destinations in Portugal and in Western Europe. Prices per square foot or meter in Porto are also significantly lower than in the capital Lisbon, so you can actually buy more and have a higher yield in Porto when compared to Lisbon. Rental yields in Porto currently are slightly more than 5% per year. Moving to Portugal is also relatively easy, whether you're an EU citizen or a non-EU citizen. That's it for today's video, so if you want to invest wisely, hit the like button and check out our other videos, and see you next time.